Well, yesterday we learned, in my opinion, that the Fed is not concerned about the U.S. economy. It is afraid. And as we talked about in the daily financial news on September 19th, I listed several things that the Fed might be afraid of. Are they afraid of the economy? Are they afraid of unemployment? Are they afraid of the election? Are they afraid of Trump? Are they afraid of Harris? But one of the things that I highlighted in there was banking crisis 2.0. So what we're going to do in this conversation with Jonathan Twomley is we are going to look at commercial real estate. We're going to look at the impact of rising cap rates, falling value. And then we're going to figure out how much does cap rates have to change for the banks to be whole. Yes, folks, I don't think cap rates have to move that much for extend and pretend to be dead. I think if cap rates move very little amount, banks will be whole. Equity will be gone. I am wondering if Jerome Powell and the Fed are afraid of banking crisis 2.0 when they are trying to set up an environment where cap rates move a little bit and the banking crisis is no crisis. Just all the equity's gone. How you doing, Jonathan?
I'm doing great, Michael. So here we are on Fed Day, or the day after Fed Day. So what
Yeah,
we've been waiting for a long time. So we'll have fun talking about it today.
absolutely. So something you and I did, we warned people this was coming probably 2 years ago. We talked about $100 million building becoming $48 million with very little changes. We're going to do the same thing. We're going to bring up a spreadsheet. We are going to run through scenarios and we're going to talk about how much does the cap rate have to move for banks to be whole, but equity be gone. But before we do that, I'd be remiss. Were you surprised by the Fed's gigantic move? Only the third time on record starting the cutting cycle with a 50. Um, Mirrors September 18th, 2007, a 50 was the first cut. So were you surprised yesterday?
I was actually. I did not think that the Fed was going to cut that much, and I thought that there was a non-zero chance that the Fed wouldn't cut at all. So I was quite surprised that it went big, and of course, since it did, now that makes me ask, well, why? Are they trying to get ahead of something that they see coming? Um, or are they really going for sort of shock and awe the same way that they did in the other direction? Maybe they've sort of changed policy. Gradualism is not uh, part of their toolkit anymore, and maybe they want to try to, as you had said many, many months ago, the Fed raised aggressively to send a message, right? And hopefully then it would not have to raise as much overall if it raised aggressively up front. I wonder if the same thing's happening in reverse, where they're trying to send a big message that'll prevent them from having to cut more altogether if they cut fast up front.
I did find it odd, right? The Fed has been telling us for years that they're data dependent. We have a proposed GDP of 3%. We have an unemployment rate currently at 4.2. We have PCE inflation above 2.5. I think it's 2.6. And yet we supercharge, we go big with a 50. To me, that just clearly means the Fed's afraid of something. And I don't know what it is. But I thought one of the things that's quite possible is commercial real estate, is the banking system. They don't want to lose 400 commercial banks because they have to kill, extend, and pretend. Something that I did not talk about today on the daily financial news, but I had it. There was a Minneapolis office building, 633,000 square feet, sold for 74 million bucks in 2019. It just sold for 6 million, 6 million, 91% discount, 10 bucks a foot. Somebody's taking a big haircut.
When was that? When was that sale?
Real Deal just posted it, so probably in the last 60 days.
Oh, interesting. Okay, because I know that there was a big sale similar to that not that long ago with a huge discount, but it turned out that it was the land had already been sold out from under
Yeah,
it.
land lease. It was a New York building. Yeah,
Yeah. So it was bad, but it wasn't as bad as
yeah.
it was 90%, but it wasn't. So I wonder if this is the same thing, because 90% is a
That's
huge, huge,
crazy.
huge haircut.
That's tear down value. You probably
Yeah.
recycle the pipes and whatnot and get your money back. Well, I came to you today because I wanted to bring up a spreadsheet. I think one of the things the Fed could be afraid of is a banking crisis. And I think of all my experts, you're the guy to help me kind of realize, am I crazy to think this? Because what I'm really feeling is we've already seen roughly a 30 to 40% haircut in commercial real estate. Now, simply said, that means cap rates went up. And if it is 40%, just to use that number, banks are on the hook for millions and millions, hundreds of millions of dollars. But I suspect if they could get cap rates to come down a little bit, that banks could be whole. Then they could stop doing extend and pretend. We could get transactions. But unfortunately, that means the equity's gone. So we're going to pull up a spreadsheet. We're going to play with some numbers, and we're just going to see how little cap rates have to move. And then we're going to talk about, am I right? Could this be what they're afraid of? You ready?
Sure.
All right. So let's share this. We're going to lay this out for folks just so you can see what we've set up. Jonathan, can you see that now?
I can, yeah.
So folks, again, in the commercial market, this is a very, very simplistic. This would not be something you would use for deal flow or deal evaluation. For that, reach out to Jonathan Twomley and all his amazing stuff. But to keep it simple for the average person like me, we're going to talk about NOI, net operating income, how much cash is left on after operations. In this case, we're going to assume this building produced $5 million in NOI. We're going to assume in this case, this building was bought with a cap rate of 5%. Quick math on that means that they paid $100 million for the building. We're going to assume they got a 70% LTV, which means they got a loan for 70 and they had to put in $30 million of equity. You can see there, folks, we have current LTV and current equity. You're going to watch those numbers change. So, Jonathan, any kind of words on this before we start playing with the numbers?
No, we've set it up, and this will, allow us to illustrate the point that we're trying to make here.
So it's fair to say, Jonathan, that cap rates, as the Fed has gone on the fastest rate rising cycle in history, that cap rates have moved off the bottom and are significantly, or at least higher than they were before. So in this theoretical situation where a building a couple of years ago sold at a cap rate of 5, what would be a realistic cap rate should this building retrade today, given what little information we have here?
Well, yeah, I mean, just based simplistically on this, I'd say if we're starting out at 5, the cap rate is probably 2 points higher than that.
Okay.
Based on where interest rates have gone. So take it up to a 7.
So in this case, folks, again, we're just going to take the cap rate up to 7. We'll play with NOI later if we want, but just watch what happens. This building traded at a 5 in 2022. It's now late 2024. We all know that cap rates are higher. So now it's a 7. Look at what happens. So the value of that building is now $71 million. The current LTV is 98%. So you're out of your debt coverage, whatever, you're in trouble. And frankly, the equity is only 1.4 million bucks. That's not good, right, Jonathan? Your loan might get called.
Yeah, I mean, this is where a lot of people have found themselves, right? And I think it's even more dramatic in some cases because buildings are trading below, 4 caps, right, in some places. So the cap rate rises even higher. But yeah, this is, you can see here that the bank is still in the money, but the equity is basically wiped out in this situation.
Yeah. So the other thing that likely happened is NOI has likely gone down, right? More vacancies, higher costs, taxes, insurance. So if we take NOI down, what do you want to take it down?
I mean, listen, let's just try taking it down by only 10% and see. So to,
so that'd be 4. Yeah. That's what I was thinking too. I think that's 4.5. Oh, that's 45. Sorry, folks. 1 extra 0. There we go. That's what I was looking at. Because one of the things that I'm trying to, the riddle I'm playing in my mind is, what the hell is the Fed scared about? And one of the things it could be is commercial real estate. So in this example, we took a building that was sold and transacted in 2022 at a 5 cap with 5 million. We have raised the cap rate from 5 to 7. We've lowered NOI only 10%. In this case, the bank is on the hook for roughly $6 million if they
Yep.
foreclose. So let's use this example. Let's assume the NOI stays the same. What I want to know is, how much does cap rate have to move for the bank to be in the money and thus in a position they could foreclose and take zero haircut? Does that make sense?
Yeah. So I would take the cap rate down 10%. So take it down to 6.3.
Bingo.
And there you go.
Let's assume
Even
you have
6.4. Just try it 6.4. That's not even 10%.
Yeah,
That
they're
now
still in the
you're
money.
yeah.
Yeah.
So cap rates don't have to compress a whole lot for banks to now be whole. And this 300,000 probably covered just about their closing costs on this transaction. So
Yeah.
they'd really be whole.
Yeah, and again, they have reserves for bad debt. But this is what I'm thinking. Again, they went out aggressive, half a cut. I don't know about you. Again, I'm very much more a residential guy, Jonathan. But I think I had 12. I might have had 14 emails from lenders announcing the Fed cut 50. Time to refi. Get that HELOC. Blah, 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 blah. Of course, as I told my audience, rates were going to get worse, and they did. So nailed it. Got that right again. But I was wondering, because you're in the commercial world, did LinkedIn, did Facebook, did your text, whatever, did it blow up yesterday with people that are in pain in the commercial real estate market going, yay, cap rates are coming down. We're going to be saved. The Fed is going to save us.
I think I didn't see a lot of that actually.
Oh, good.
Surprisingly enough, I saw a lot of was like kind of what you're talking about now. Like, well, wow, what's the Fed worried about, right? And a lot of people who were saying essentially that, yeah, the Fed cut, but the rate cuts had already been baked into interest rates.
Yeah, rates
Mortgage
went up,
rates,
man. Rates
yeah,
went up.
they were already right. Rates went up because everyone was like, well, we were expecting 25 and now the Fed did 50. So what's wrong? Right.
Exactly.
So but I think a lot of people who are kind of more sophisticated, cooler heads out there were saying two things. One is that, well, hey, what's going on with the economy? What's the Fed worried about? What do they see coming down the pike if they've done this large, cut? But the other thing, being that, well, look, interest rates were already lower because everyone was anticipating this cut. And so interest rates won't really change that much. And there's also a lot, there's not a direct correlation between interest rates and cap rates, right? So there's a lot that goes into the cap rate that's not just interest rate. Now, over the long run, you can see about a 200 basis point or so correlation between, what you're borrowing at and your cap rate. But in the short run, you don't, there's compression, decompression, right? One of the things that one of the biggest determinants of it is investor interest in the asset, right? So if the equity is scared, and I don't think that this interest rate cut is going to really change people's perceptions, right? If the equity is scared and you still need to provide a higher return to get the equity interested, this interest rate, yeah, I mean, it helps a little bit, but it's not going to help that
key.
much.
That's the key is, again, I don't know what the Fed's afraid of. We're talking banking crisis. I don't think cap rates have to move that much. I think in this very simplistic example, they moved like what, 0.6% or 0.5, something like that. I think the Fed's playing at the edges. And again, I think there was a troubled bank list produced a quarter ago that had like 417 banks on it. Most of them were identified as small and regional, likely because of commercial real estate. I don't think, I mean, if the bank is looking at that going, oh my God, that's a tsunami, they don't have to get cap rates down very much for the banks to be whole. I mean, we just proved it, right?
Yeah, yeah. And I think what you'll see too is that like a lot of deals need a lot more cap rate movement for them to be whole, right? But
Well,
the banks will be whole at a lower level, like you're saying.
that's exactly right. I don't think
And
the Fed has any interest in bailing out equity. They
no,
can't. They
no,
can't go that low.
well, not only that, but I mean, that creates a big moral hazard problem, right? When they start bailing
Bingo.
out equity and saying, "Oh, we're going to protect you from all of your bad decision making,
Mm-hmm.
Mr. Investor, with your risk capital," right? But
Yep.
so what I'm getting at here, though, is that there are definitely. So I think this is going to ease. So a slight movement in cap rates, but even just actually without even cap rates changing, interest rates changing, interest rates dropping the way that they have, right? It will mean that on the margin, some loans with variable rate debt
Get
will
a
shift
little bit
downward,
better. Yep.
right? Get a little bit better and either push those properties into, you know, a cash flow positive situation, or you know what I mean? It'll push them into being able to pay their debt
Yeah.
wholly, right? Or it'll push them over that magic 125x, you know,
Again, I don't think,
line, right?
again, there's a lot of things the Fed could be afraid of. This is the banking crisis. I think the Fed is looking at this as how do we protect the banking system?
Right. But this will just, but this is also like, look at it, think about it this way. Like the banks, I mean, we all know how banking works, right? They've got, if they're marketing deals so none of this stuff has to actually get sold. They just need a couple of deals to get sold to show that the cap rates have gone down, right?
Mhm.
Then everybody can they can revalue all these
Yep.
assets on their balance sheets, and now suddenly they're solvent, right? So they don't even have to do anything. They can just they can
Yep.
continue extend and pretend, right? Because that way they can just, okay, if it ain't broke, don't fix it,
Well,
right?
I
But
don't
they
know.
can,
Let's play with that because I don't think that's right.
no, see, because I think that going to foreclosure will have the effect that they don't want it to have, right? Because if they start going to foreclosures,
Sure.
then they will push cap rates back up again,
Mhm.
and they don't want that to happen, right? So
Yeah.
I think what you'll see is there probably just needs to be a few sales in the market that show that
Established
cap rates
value.
are
Yeah.
coming, yeah, that show that
Yeah.
cap rates are coming down, then everybody can benchmark to those deals, and then they're good. But if they go and they say, hey, look, we just want to recycle this capital into something else, so we're gonna foreclose, like that's a slippery slope, because then, as we've talked about on this podcast before, if everybody will try to beat the market and be first, and then all that does is cause a crash. So
Yeah.
I think that extend and pretend is here to stay for a
Okay.
while, and but this will just mean that, assuming that cap rates do change in the right direction, this will just ease the burden on the banks in terms of their balance sheets.
Well, the Fed has told us again, according to their dot plot, that we've got at least another 50 basis points incoming this year, potentially up to another 150 basis points by the summer of next year. Again, I think there's something, again, don't know what it is, but in this conversation, it's banking crisis. I don't think they have to move cap rates much for the insolvency to disappear, like we were just talking about.
Well, I mean, they've got to move them by 20%, right? Basically, yeah.
Yeah.
So if they do cut by 200 basis points, that'll eventually work its way through the system and help out a lot. So who knows?
Yeah.
Maybe they'll avert a foreclosure crisis and avert a banking crisis, and they'll achieve that soft landing, and everybody will be surprised.
There
So
you go. There you
yeah,
go. Well, I do have another topic for us to do in video number 2, but before we get to that, Jonathan, where can people find you?
yeah. So come follow me on LinkedIn and join the conversation there. You can also join my school group, which is school.com/AIC for Apartment Investors Club.
Oh, I
And
like that.
yep, take my course and hang out with me there. So
Cool. Thanks, Jonathan.
yep.